Senate Banking Committee hearing. The nation's top financial regulator says the Federal Reserve warned Silicon Valley Bank as early as the fall of 2021 that its business model was at risk. SVB collapsed when uninsured depositors began to pull their money out of the bank all at once. Federal Reserve Vice Chair Michael Barr called SVB's failure, quote, a textbook case of mismanagement. The Fed said it's considering whether stronger rules are needed to prevent further failures, and it will review whether the collapses can be partially blamed on a 2018 law that weakened bank regulations. So joining me now is Puspa Amri, who is an economics professor at Sonoma State University. Puspa, thank you so much for joining us this morning.
Thank you for having me.
All right, so you hear what the chair said here. He acknowledged that supervisors at the Fed pointed out the issues at Silicon Valley Bank back in 2001 and that the bank waited too long to address the problems. Did we learn in that hearing yesterday why regulators didn't act sooner to prevent the collapse?
We did hear it definitively. However, from my understanding is that there's a difference between the issue of the regulations that are on the book and the regulators' ability to actually enforce the actions. Several warnings have been made, several courses of what bank examiners say requiring immediate action were put forward and discussed with the management. However, there is an unclear link between how much of that warning sign actually carries weight in terms of how regulators and supervisors can force banks to carry out those differences in practices.
And I think the vice chair of the Federal Reserve said they just don't have the clause to move as harshly on certain things they want to address. Is that what you heard as well?
That's what I heard as well. Yeah. And that's not an experience that is unique to the Federal Reserve. In my experience studying financial regulations in other countries, the supervision part is always the difficult part to ensure. There's a lot of also legal rights from the bank itself to bring in their own team to suggest their own course of corrective action. However, that's not very reassuring for the financial community at large, for public society at large, who of course is affected by this and whose taxpayer monies is in some way being mobilized to deal with this situation.
So if the Federal Reserve doesn't have the teeth to enforce more than advise, what is the backstop here for these banks to make sure that they're being overseen properly and to be managed properly? Is there anything in place right now currently that you know of?
There could be more changes in the laws to make this to make the enforcement problem, as you said, carry greater weight, have more teeth, if you will. But also, I think in the nature of regulations are always be lagging to the problems. There was a lot of focus on supervising and making sure banks were not repeating the same mistakes as 2008. Yes, we did see that. There wasn't an overballooning of credit going to non-creditworthy borrowers. But the thing with a banking crisis or in financial instability is that the trigger to the next crisis is usually always different from the last, and not all regulators are always able to address that in real time. So I think it's a complicated issue.
The other issue, they said they're looking into whether the collapses can be partly blamed on the 2018 law that weakened banking regulations. What can you tell us about that and why that would have contributed to this?
Sure. So the 2008 weakening of the DoddFrank Act created exceptions for mid-sized banks to, one, hold less capital to cushion themselves in case of a situation of a run in their deposits, and two, it relieved them of obligations to do stress tests, i.e., every once in a while, regulators will come in and ask, if this scenario happens, if there's a recession or if there's an increase in interest rates, does your balance sheet have the ability to withstand that shock? So mid-sized banks such as Silicon Valley Bank had been exempted from these regulations since 2018. There is a mixed view on that. Some say that that definitely did play a role in preventing this kind of thing from happening, because otherwise, stress tests, if you hold regularly, probably these kinds of problems would have been picked up from the beginning. However, the extent to which that was the definitive factor was not clear. I believe it may have been an important factor, but not the only one.
So what could we see happen next year as you were watching all this? I know they're meeting again with another committee soon, but what were you watching for as an expert in this field?
Okay, thanks for that question. I'm watching for how to make the system as a whole less prone to such kinds of shocks. And so I think what the regulators are trying to do right now, for one, they are doing, I believe the FDIC and the Federal Reserve are doing an internal investigation around among themselves, their own institution. What happened here? Why did this happen in our backyard? And the second one that I'm trying to, I would be watching out for is how do we deal with the situation that we have, admittedly, a lot of depositors, deposit accounts that are in the amount that are over the current limit coverage of 250,000. So in my view, there should probably be more regulation to watch and make sure banks don't hold a too high of a proportion of their deposits that are uninsured. Like I think Silicon Valley Bank had 90% of its deposit accounts above that limit. And the second one is, this is my wish list, to try to make banks not be so concentrated in their deposit portfolio.
Gotcha.
I think we all know that this was the problem, because once a person who is a depositor hears rumors of their bank not safe, this then builds panic and could travel to other banks that are maybe also healthy. We saw that already on that same day that the Federal Reserve, Federal FDIC took over SVB, shares for several other mid-sized banks, including, of course, the one in San Francisco itself and Pacific West, had already collapsed. So depositors, investors automatically look at possibilities of what other banks are holding similar portfolios, having similar kinds of problems as Silicon Valley Bank, and kind of blindly just run on that or sell shares of those banks. So to answer your question, surely I think it should be more, definitely should be smarter regulation.
Smarter regulation.
On what the issue is.
All right. Professor Puspa Amri from Sonoma State, thank you so much for your insight into this topic this morning. We appreciate it.
Thank you. Have a good day.
All right.